Hi, everyone. Welcome to our webinar on personalized pricing, optimizing regular and promotions together. I'm Sarah Stockton, VP of Product Management at ClearDemand. Presenting today is Dr. Jim Sills, President and CEO of ClearDemand. Jim co-founded ClearDemand 12 years ago with the mission of building a true constrained optimization solution that brings the best of both worlds to pricing and promotion, innovative science and comprehensive rules. Prior to starting ClearDemand, Dr. Sills pioneered the first price optimization solution for retail at Kaimetrics and was the CTO at Revionics. He worked in signal intelligence for a number of years at Southwest Research Institute and taught at the University of Texas. He earned his Ph.D. at Georgia Tech. Dr. Sills has published over 20 papers and has nearly 20 patents. In our last webinar, we talked about the fundamentals of retail pricing rules. Today, we're going to explore the new frontiers of pricing and promotional science. We welcome your questions submitted through the question window. Please submit questions as we go through the material, and we will address them during the webinar. Your questions will remain anonymous. With no further ado, here is Dr. Sills.
Thank you so much, Sarah. I'm humbled by that introduction. Really, I'm just a person. I'm just a dad and a husband and all those kinds of things. And believe me, my kids keep me very humble. But I am very excited about our webinar today. So, there's a few themes we're going to be covering today, and that is, I think what I want you to come away with today is a realization that there are large profit and revenue opportunities in localizing your pricing, whether that localization is by store or by time or by customer. And when I say by customer, I'm really now referring to personalized pricing. And when I say time, I'm really referring to dynamic pricing, like pricing on the weekend differently than during the week, running promotions, maybe having a discount on the fresh bread in the evening before it goes, bad, and so on. And what we're going to look at, because, when I started ClearDemand with my partners 12 years ago, we wanted to do what Sarah mentioned, and that was we wanted to do a true constrained optimization of price with rules and with optimization. Today, we have a new mission, and that is to jointly optimize regular and promotion pricing. I think most retailers will accept and intuitively kind of believe that regular pricing and promotion pricing should not be done in silos, but really the two go hand in hand, and you can do better as a retailer if your regular prices and your promo prices are working together, are working in conjunction with your pricing strategy. And we're gonna really dig into this today. And it's a little mathematical, so I'm gonna try to make it as easy to understand as possible. I'll take up that challenge. But what you're gonna find is something that's probably gonna be a little counterintuitive to you. I think that as a retailer, your intuition says, gosh, I think what I should do is pick my regular price and then optimize my promo off of that, if you will. And what you're going to see today is that if you look at the math, you're going to find the opposite is true. You're going to find that really there's strong advantages to focusing on the promo price, and that includes understanding the promo strategy, working with the vendor on the trade funds, and once those things are decided, then only then can you really optimize and set your regular price. So I think this is going to be very interesting. You may find that it's going to take some thought to really understand some of the things we're going to be presenting today, but I will do my best. I promise you, I will do my best to make this as intuitive and understandable as possible. So we have a very simple agenda. We're going to review some basic concepts, and then we're going to look at personalized pricing, pure personalized pricing. And then we're going to look at the joint optimization of promo and regular. And in both cases, this counterintuitive result will emerge. And then we'll have discussion and questions and so on. And all through the presentation, we're going to be thinking about the 4th of July holiday that's just next week. And who doesn't like hot dogs? So very recently, a retailer promoted these hot dogs at a $2.99 price, and it, as shown here, it says save $1.60. So as you can see, what was being presented to the shopper was not only a promo price, but a savings. And that savings couples regular price and promo price. And it is this coupling that, that calls for the joint optimization of regular and promo, because one could ask, okay, what if it was $2.99 save $1? Would that be better? What if it was $2.90? What if it was $1.99 save $2? What is the best combination of that regular price and that promo price to achieve, your strategy for profit and revenue? That's going to be the theme of what we're going to go through today. So let's start with reviewing some concepts. And these concepts have been covered in some of our previous webinars. So I would encourage anyone to go view those webinars. I think there's a lot of insight there, but we're just going to do a brief review. So retail data looks like this. This is not untypical. What you're seeing here is price in units over time. And there's a period of time in the distant history where the price was $2.99, and on average for every week it sold, this item, these hot dogs sold about 33 units. Now that could be in one store, that could be in a zone of many stores, but it really doesn't matter for what we're discussing here. It's just 33 units at $2.99, and then the price went up to $3.49, and the units dropped to 26 units. So all that data that is on the screen really comes down to these two data points. At $3.49, you sell 26, and at $2.99, you sell 33. And in the previous webinars, we've talked about this concept of demand modeling, where you fit a curve to these two data points. And from this curve, now you can forecast unit sales at any price. And the curve has this exponential form that's shown on the screen. And in this case, we're using some, we've got some very simple parameters where the beta naught is 0.5 and the Q naught is 5. So very round numbers, very easy to do math with, if you want to do some calculations on your calculator. The beta, I'll just mention, is related to the price elasticity. It determines, how sensitive shoppers are to the price. So with that, there's only one other piece of information we really need to do a whole lot of work with this product, and that is the cost. And in this case, the cost is $1.75. Okay, so with unit sales, price, and cost, I know profit and revenue. And those are very simple formulas. Anyone on this call should have these formulas really ingrained in their mind. So if you plot profit and revenue, they look like this. And it doesn't matter what product you're looking at, what the elasticity is, they all look like this. They just have different general shapes. So let's highlight a few things that we're looking at here. You're looking at revenue, revenue always reaches a maximum at a price that is lower than where profit reaches a maximum. That is true of every product, as provided cost is not negative. And profit always crosses the y-axis when the price is equal to the cost. That, this is not rocket science, but, it's kind of nice to know. These are nice things to know. So in this region between maximum revenue and maximum profit, there's a trade-off between profit and revenue. You can raise the price, make more profit, but you're going to be giving up revenue. And that is the fundamental condition of retail. You're always trading profit and revenue. One can argue that anytime you're priced above max profit, you're giving up profit and revenue. You could lower the price and make more profit and revenue. And anytime you're priced below max revenue, you're giving up profit and revenue as well. So you really want to be in this, what we call the sweet spot, which is between these two peaks. And what's also interesting is in this area, profit's very flat. So you could lower the price, give up very little profit, but look how steep revenue is. It's very steep. So you can make more revenue. Same thing over here. Revenue is pretty flat, but profit's steep. So it's this trade-off between profit and revenue that's so fundamental. Now, if you define value as being lambda times profit, and that funny character capital pi is profit. If you define value as profit is lambda times profit plus 1 minus lambda times revenue, that's a sensible thing to do, because now your lambda parameter defines your price strategy, and in terms of how much do you value profit over revenue. If lambda is 1, then the value is profit plus 1 minus 1, which means revenue goes away, which means all I care about is profit. So if lambda is 1, you only care about profit. If lambda is 0, profit goes away and you only care about revenue. And anywhere in between there is some blending of profit and revenue. Well, it turns out that if that's how you define value, then the optimum price is this. And I point this out because we're going to be expanding the form of this optimum price under conditions of promotion and personalized pricing. And you're going to see this formula emerging within those equations. And you need to be able to recognize, aha, that's just the regular price when there's no promotion or there's no discount for a certain customer segment or a coupon or a loyalty price and so on. So this again, this is like profit and revenue. This is fundamental to pricing. Really, everyone on this call should have this just ingrained in their mind. So a couple little data points just to notice that are going to come up again as we go forward, and then we're done with our review of some concepts in the background. And that is, this max revenue price occurs when, max revenue means lambda is 0, so it's 1 over beta. If you remember, beta was 1/2, so the max revenue price is $2. That's the price when you make the most revenue possible. And the max profit price is 1 over beta plus cost, because now lambda is 1. So you have your $2 plus your $1.75, you're up at $3.75. That is the maximum profit price. So those two prices, $2 and $3.75, are kind of bound the range of pricing that really we ought to be in. And the maximum revenue is $109. Okay, so the most that you can make on these hot dogs in a given week is $109 in revenue, and $46 of profit would be the most profit you can make. But if you're making that much profit, you're not making as much revenue. And what you're doing is giving up some units to the competition. So this strategy is pursued when you're trying to compete with Walmart, you're trying to really get market share. This strategy is being pursued when you're trying to pay dividends to your shareholders. So now we're done with our concepts and we're ready to move into personalized pricing. So a couple very interesting things. If I was priced at $2.99, I would be right here. So basically that's $3, but say $2.99. And it turns out that the number of units when you're priced at $2.99 is 33 units. My revenue there is $99. And it turns out that that revenue is equal to the area of this square. Well, why does that stand to reason? Because revenue is units, which is this dimension, times price, which is that dimension. So the area of that rectangle is your revenue. So this demand curve has that benefit of very, visually displaying what your revenue is. And it turns out that your profit is this rectangle. So the profit is price minus cost. So there's your price minus your cost. That's this leg of this rectangle times the units. That's your profit. Turns out that profit is $41. Now, that means at that price, I'm going to sell 33 units. And let's just say every shopper buys 1 unit. So that means 33 baskets are going to come into the store and they're going to buy this item. And there are some people who would have paid a higher price and bought it, maybe because they just had to have it. And there's a lot of people who, if it was a lower price, would have bought it. So here's the thing about personalized pricing. What if I was able, and in a sense, this is like a magic store. Okay, so suspend disbelief and just assume that somehow I can identify those shoppers who are willing to pay $2.99 and I'm going to charge them $2.99. But I'm also going to find those shoppers who are willing to pay, the remaining shoppers who are willing to pay $1.99, and I'm going to somehow communicate to them that they can buy the item at $1.99, and that's the price that they're willing to pay, so they buy it. So my profit goes from $41. We pick up this additional rectangle, so it becomes $46. Okay, and we also get this additional revenue. Okay, so that's kind of interesting. It's interesting that if you could differentiate your pricing by customer segment, you can make more profit, more revenue. And I don't think anybody's surprised by that. The question is, well, how much more revenue and profit can you get? Turns out it's huge, or let's just say large. So let's add another price point. Let's say that for those shoppers that are willing to pay $4.99, I could somehow, communicate a price to them. And now look at this, my profit is $70. That's hugely, that's a large increase. So what does it look like in the limit? Well, in the limit, my total revenue is the area under this curve. It's every shopper gets the price they're willing to pay. Now, I know this is a magic store, and I'm asking you to suspend belief that I could actually do this. But what I want you to understand is what is the ultimate benefit? What is possible if you could do such a thing? And it turns out that now your revenue goes up to $297. Now, remember the $109 price point I mentioned earlier? So with one price, all you can do is get a revenue of $109. That's the most you can do. That's that one rectangle at max revenue. But if you could do this, you could triple that revenue. Okay, that's a lot. Okay, so let's talk about profit. So with profit, it turns out that I had to buy this many units to be able to sell all this revenue, and that's a lot of units that I'd have to buy, and times the cost of $1.75. So that rectangle represents my total cost. So my profit is really not that good. Why? Well, I sold a whole bunch of units below cost. and I lost money on every one of them. So you don't want to do that. So what you really want to do is sell every unit you can above cost, but you want to get the most, the highest price you can for every one of those sales. And it turns out that when you do that, then the cost is only this rectangle, and it's just 62 units. And so now you're making, a sizable revenue and a very sizable profit. So let's review. Okay, let's review how all this kind of stacks up, and then we're going to look at some optimization. So we talked about the max revenue price, and I think we said $109. This is $110. I just realized I rounded a little bit differently between the two numbers, but that's that $109 we had before. Very minimal profit if you're going for max revenue. Max profit was at a 375. That's a lambda of 1, and you're making a decent amount of profit. You still have a decent amount of revenue. And if you wanted to kind of go in between, you could be in here. Now, we looked at 2 prices, kind of arbitrarily picked. Then we looked at 3 prices arbitrarily picked. And then we said, okay, all prices. And then we said, okay, price always bigger than cost. And this is how profit and revenue stacks up between all of these. Just kind of some interesting insight. This doesn't give you anything to go, storm the gates of the castle with in retail, but some good background. Now we're going to optimize. Okay, so the question is, let's assume that I'm going to have some kind of a regular price, that's P naught, and some kind of a discount price. Okay, and that the regular price is greater than the discount price, and the discount price is greater than cost. These are not strong assumptions. And now we're going to say, okay, and we're going to say that the discount price is known. Now, there's a reason I said that. It's because I looked at all the math and I found out that there's this insight that says you really need to pick the discount price first, and from that, the regular price falls out. And it doesn't matter what the discount price is. Pick any discount price you want, providing it's in this range. And I'm going to show you what the optimum regular price is, given that the discount price has been picked. Okay. And it turns out that discount, that regular price is equal to the discount price plus 1 over beta 0. That is a remarkable formula, okay, and one that I'm not aware has ever really been surfaced in retail ever, really. Maybe somebody's had this insight, but I kind of doubt it, but I could be wrong. And I'm sitting here in the room with Adam Rosenberg and Sarah Stockton, and Adam is our chief science officer, and this was really his insight. So the reason this falls out is because when you pick the discount price, you're going to sell this amount. You've already bought the items. All you're trying to do is maximize revenue. And remember, max revenue is 1 over beta. And from this point forward, you still have just an exponential. And the exponential is invariant in the sense that the rectangle that maximizes the area under this exponential is always 1 over beta. And that's why this works out. So that is absolutely remarkable. It's a remarkable result. Now, what's the optimum discount price? Okay, so now what's interesting is, well, it turns out we've already got the regular price because it's a function of the discount price. So it turns out that I can, again, maximize my value, which is lambda profit plus 1 minus lambda times revenue. And this is where it gets a little bit mathy. And I'm not going to go through all this math. What I want to do is just show, take a screenshot, go through it. It's really just, Adam went to a better high school than me. He said, this is high school math. It's calculus. I didn't get this kind of math till I was really in college. So to me, this is college math, but Adam went to kind of an extraordinary high school in Philadelphia, and he says that this is just high school math. But anyway, this is the equation for your discount price. It's lambda C plus 1 over beta. Remember, that's just the optimum price. Okay, that's our formula. That's what we started with. That's how we've been pricing forever. But you're going to discount that by 1 over beta naught E. This is a remarkable insight. It says that the discount price is independent of the regular price completely. It is just a function of your strategy lambda and your price sensitivity and your cost. And it is lower than it, by saying that this is a discount price and there is a regular price, the only impact is that you're going to lower that discount price in amount that is determined by the price sensitivity. And that's it. It doesn't, picking the regular price has no bearing on what this price should be. But once you've picked this price, then the regular price should be that discount price plus 1 over beta. And this is an extraordinary insight. And it changes everything about how you should think about regular price and a discount price that's a function of, say, a coupon. Because that, obviously there's lots of challenges in reaching that population of customers who you don't want to send the coupon to the people who are willing to pay these prices because they're going to buy anyway. You want to send the coupon to these people who are not going to buy at this higher price. They're going to buy at this lower price. Those people are, if you could send every one of them a coupon, and if it could register in their brain, and I know the challenges of that, that's a magic store. And I'm asking you to suspend disbelief, but this is what the math says, and the math, the math guides us in our decisions. It's not the only, there's still a whole lot of creativity and intuition that goes into the buyer, and the pricing analysts and so on who are doing this work, but they're going to be a lot better off if they understand this if they understand the math and are guided by it and guided by the data that they have in their sales history. So now, if we use those two optimum prices, okay, so that's what those two equations will yield is these two prices, and I did that for a lambda of 0.5. Then your revenue is $146 and your profit is $58. So that far exceeds the revenue that you can get with one price, and it far exceeds the profit that you can get with one price. So this idea of personalized pricing now, and by the way, so this is kind of how we've approached this. We've said, look, it's, that theory of every shopper gets its own individualized price, that's nice. Well, I recognize that that's not really easily achieved at all. But two prices is not that far from the realm of possibility, and the benefits are substantial. Okay, so I think that was very interesting. Now, that is not a promoted price. There's no promotional lift. There's no vendor deal. We're going to now look at promo pricing and the joint optimization of promo and regular. And in fact, we're going to really focus on something that you should find very relevant to your business, and that is the regular price for those items that are on the front page. this item was on the front page last week at a major retailer. I wouldn't be surprised if it's on the front page again this week, given 4th of July is coming. And the issue is what is the optimum promo price? What is the optimum regular price for this item that is, promoted, with some regularity on the front page? Okay, that is a very valid question that one would ask. And I'm going to show you that the retailer had this promo price. So now P1, it's the discount price, it's the promo price, just like before. The regular price, is that plus the $1.60, so it's $4.59. And I'm going to show you that the optimum prices are. It turns out that the promo prices they were right on with the promo price. It was $2.99, but the regular price was too high. The lambda, now this promo price is optimum with a lambda of 0.9. So they're putting a big value on profit, whether they intended to or not. But what I wanted to show was that, with that lambda, I can make the same amount of profit, but more revenue overall with these prices compared to those prices. And to do this, I'm going to have, we're going to look at the world as follows. We're going to have a demand curve that tells us, how much we'll sell on regular when the price is just the regular price, and how much we'll sell on promo. So when you sell on promo, you tend, especially on the front page, you tend to get a lift because a lot of people are seeing that item. It's the power of suggestion is a real thing. People buy it just because because they see it. But then also the people who are looking at the ad tend to be more price sensitive. And so units go up a little quicker with the discounts. And so there's a few things we're going to have in this analysis that we're going to have to define. One, we're going to say that the amount of time it's on promo, this F means fraction of promo, fraction of price one, is going to be 25%. So about 1 out of every 4 weeks, we're assuming we're going to say this is going to be on the front page. Now, this may only be true for certain periods of time, but it's a number that that we picked, and which means that 3/4 of the time it's on regular. Now, obviously, maybe it's on TPR, some of these, from time to time. We're going to keep this fairly simple so that we can, not get caught up in all that complexity. Just a simple example. The cost during the regular sales is $1.75. We're going to assume the vendor gives us a nice 25% off discount to put it on the front page. We're going to assume a lift, a QL of 1. I'll show you what that is. That relates to Q naught, which was 5. So it's like a 20% lift in Q. And this delta beta is a discount elasticity, if you will. And what it says is that as this number goes up, as the regular price goes up, certain people will be more enticed to buy because they perceive it as a greater discount. And Adam told me a really interesting story. He said, I was on 2 websites, both had the same price for the same item, but one had a bigger discount because the regular price was higher on the other website than the other. And he said he bought the one that was at the bigger discount, even though it was the same price. It was a perception of, oh, if their regular price is higher, they must have greater service, or, there's all kinds of things that go into the psychology of this. And I'm not, here to answer, all those questions. I'm just going to say that generally, as you discount more, there's a perception that, oh, this is a greater opportunity to buy. So the formula that we're using is right here. So this is our regular formula that we've always used. And now we're adding the lift for it being on promotion, that's Q sub L. And the discount between the promo price and the regular price it gives us an additional lift determined by this delta beta. And I've told you what all these things are. Okay, now, if you go through this and you look at all the math, and I'm not here to go through all this math, but I'm here to tell you that if you optimize the regular price, it turns out, if you optimize the promo price, price one, the regular price just falls right out. And it turns out that your optimum promoted price is lambda C1, so it's the cost during the promotion, with your strategy for profit and revenue, plus 1 over, not beta 0 like we've always have had, but beta 0 plus delta beta. A remarkable insight. It tells us that the promo price can be set completely independent of regular price. And when I started the webinar, I said, you're going to find this counterintuitive, because I think most retailers think, oh, this is the regular price. Now I need to set the best promo price based on that regular price. And the math, as counterintuitive as it may be, says something very different. It says you should set the promo price first. Okay, if you don't believe the math or you want to go through the math, we can do that another time, and we'd be happy to do that. Now, here's the thing though. Once you've set your promo price, now you have to set your regular price, and this equation looks horrific. Okay, for most of the people who are intimidated by math are probably running for the door right now, saying, "Get me out of here." Now, let me explain. This is understandable, because look at what's embedded in our regular price. It's lambda C plus 1 over beta. That's our old friend. So if there's no promo, if your fraction of promo is 0, or if your discount lift is 0, all this goes away and you have our regular old friend. The regular price can be set independently because there is no promo. But if there is a promo, then you have then the promo price comes into play. The promo cost comes into play. These fractions and these ratios come into play. The lift comes into play. And then this is astounding. Okay, this is where you say, oh, Jim, okay, you just went off the rails. Yeah, no. I'm going to leave the webinar now. How can P0, the regular price, be a function of the regular price? Well, this is what's called a nonlinear equation. Turns out that this is not a scary equation. If you just pick a P0, you pick a P1, and then you pick a P0, or you solve for P1, as we mentioned, pick a P0, plug it into this equation, you get a new P0, plug that into the equation, you get a new P0, plug it in again, and after 3 iterations, you've got your P0. And so this is called a recursive solution to a nonlinear equation. It's very doable. It's not anything scary at all, and it's legit. And it turns out that if you do that, you come up with your regular price being $4.19. And what that means to you is, if you were to do what was done in the ad, you're gonna realize over a average week, or where a quarter of the time, okay, I should say more like an average month, but these are all weekly numbers. These are all average weekly numbers. But obviously, you're going to be selling on promo for, say, 1 week out of the month. So don't get too caught up in that. But with these two prices, you are yielding a $71 profit and a $130 revenue. With these two prices, I can achieve the same profit, and my revenue is $133. Okay, and so you may be saying, oh, wow, that was a lot of math to get $3. That's a 200 basis point improvement in revenue. Okay, retailers are taking only about 200 basis points of their revenue to the bank, maybe 400 basis points. This is significant. The profit margins are so slim in grocery retail, especially, that this is the world that we live in requires this level of sophistication to thrive. If you want to be a retailer in the 21st century and you want to thrive, that $3 matters big time. Okay, so, and again, what's really interesting is you had to pick the promo price first, and then, which can be optimized, and then the regular price falls out. Very counterintuitive. Now, very recent. So now we're going to move into our discussion phase, and we're going to answer questions and so on. Now, recently I was at our customer summit, and I asked, a number of leading retailers, why do they promote? And the reason, and people gave me all this, all the standard answers to drive traffic and so on. But really, the reason you promote is to get more profit and revenue, depending on your strategy. And what we've shown here today is that there is an enormous opportunity. Well, I'm going to say large. I don't want to, say enormous or huge. It's large. There's a large opportunity to drive additional profit and revenue by promoting, by pricing your promotions and your regular prices optimally or jointly. And so now now I'm going to remove myself from all the math, and we're just going to talk about what does this really mean to a retailer? Well, it's significant. When we started retail pricing, 20, 30 years ago, and started thinking about, how to optimize price in grocery and other retail channels, we took, we all knew at those days, in those days about what was going on in revenue management for the hotel industry and the airlines industry. And what they were doing was they were putting up fences. Okay, they were basically saying, if you buy early, we'll give you a discount. If you buy, under certain conditions, we'll give you, like if you book a return flight after Saturday, we'll give you a discount. There's all these, all these fences. If you buy in coach versus exit and first class, and so they would differentiate their prices to achieve more profit and revenue. And we really, early on, retailers just had a regular price, a promo price. Then they started, then coupons. I mean, coupons are as old as dirt, and loyalty. But what we're seeing now is, and where we're going in retail is to really combine this revenue management with retail price optimization, which by optimizing, what those coupons should be, what those loyalty prices should be. There's other ways to differentiate price. There's multi-buy. You can give people who are willing to buy 2 or 3 or 4 a discount. You can, do bundles and give people a discount when they buy a bundle. You can give them a discount if they achieve a certain basket size. Like, if you spend $20 in your basket, we'll give you a discount. But if you spend $100, we'll give you a greater discount. These are ways that you can nudge shoppers to behave differently and to capture more of their spend. TPRs are promotions, but they are also a fence. They're people who shop during the TPR. Same with a flyer. Some people come to the senior day, which is a day of the month, or some people shop on the weekend, which is a day of the week, or on a Wednesday. There's a lot of discounts or double promotions on Wednesdays that you see sometimes. Some people will buy online versus in store. There's lots of ways that you can set up these fences where you can charge a higher price for those who are willing to pay it and a lower price for those who aren't. And now there's a couple other things here. That, in this analysis, there was this term called delta beta. That is an interesting term because it's not just a price elasticity, it's a discount elasticity. And when you promote, it's one thing to say, oh, I promoted at this price, I sold this much. But if the discount was off of a higher price versus a lower price, that matters. And so to really model this delta beta, you have to have that history. You have to have that information about what was the regular price at the time of the promotion. If you don't have that, and I think some retailers will find, I don't have that. That's not easy to get that data. Well, I would encourage a measure and learn approach. I would encourage doing some different discounts and getting a read on what is that discount elasticity. There's ways to do that measure and learning. So these things can be done. Now, I'm not going to say that this is all super easy. A slam dunk, go. Everything's solved now. Let's just nothing to worry about. Well, there's lots to worry about. That's why I say that there's still 20 years of innovation before us, and that is cannibalization affinity is a very important element of promotion. Private label and national brand. I mean, the national brands are getting you to promote, and you could be cannibalizing your private label that give you a higher margin. To really assess your promotions and to promote, optimally, you need to understand cannibalization affinity, what's being cannibalized, where the affinity is coming from. There's forward buy happening where some of those shoppers who are willing to pay that higher price, they jump on that promotion and they buy. They have plenty of pantry space. They have the cash to buy, so they do, and that promotion could just be robbing you of future sales that you would have gotten if you hadn't promoted. So you have to understand that. And then other times you have cherry picking. People just come in and buy the promotion and that's all they do, which is why the basket, I'm so excited about the idea that, oh, you only get this promotion if your basket is a certain size. You can really, it's a great great countermeasure to cherry picking. So those were the thoughts I wanted to leave you with today. Gosh, we're at 10 minutes.
We do have some questions.
Sarah says we have some questions. What do we got, Sarah?
All right, Jim. So how does the limitations of inventory impact an optimization?
Well, that's very key. That gets to this concept that in retail, everything has to work together. There has to be like complete synergy between your assortment, your inventory, your space, your price, your promotion. If you promote and you run out, it's very detrimental. You're frustrating your shoppers. If you promote and you're left with a whole lot of extra that's has a shelf life, that's a big problem for you too. So what's key is to understand and to accurately to accurately forecast what you're going to sell and to connect that to your supply chain. So, your supply chain, your replenishment systems need to be cognizant of the promotions and how much lift you're going to get from that promotion based on the price of that promotion, the discount off of regular, any displays you're doing, whether it's front page, whether it's a major feature, all of those considerations, all those factors that will influence units have to be reflected in that forecast to avoid those overstock situations and those understock situations. And to be able to do that properly, you've got to be able to really do some pretty sophisticated analysis of your history to know, how susceptible are you or have you been to stockouts in the past? That's our wheelhouse at ClearDemand, is really getting that forecast as accurate as possible, so that all these things work together, and you achieve the profitability and the revenue and the market share you're after with the right service level and minimal carrying cost.
Great. All right, got a couple more for you too. Okay.
Okay.
How does the frequency of promotions affect the joint optimization of pricing and promotion?
Oh, that's a really good one. You have to be, I would say when you're running your promotions regularly, there could be advantages and disadvantages to that. The disadvantage is you start training people to only buy on promotion. And some of these people would buy even without the promotion. And the advantage is, some people, we'll also train some people to come in and shop. Those who really need or want that lower price, you'll capture their visit. As far as and really, so there are these additional dynamics that the math that we've presented today are not considering, but those things do have to be considered if you're going to squeeze every last penny out of the business and do things as optimally as possible.
Great. What kind of data do you need to perform this analysis?
So what we prefer to have is transaction log data. This means that we can see, especially transaction log data that ties to some sort of an identifier where we can see, oh, this shopper or this household came in, on Tuesday and they bought a $100 basket with these items in it. And then a week later, they came back and they bought, a $50 basket. If we can start to see what people are buying, what they're not buying, what's in their basket, what shows up in the basket at the same time in the same transaction, then we can really get more insight into where we could promote, because if you saw that, hey, I've got a shopper, that seems like they would be real interested in this item, but they don't, their baskets are like under $20. Well, let's give them a coupon, but they have to spend $20. Or if they're not buying a certain product in their assortment, like maybe the paper products, well, they're probably going to Costco to get their paper. Let's give them some discounts on paper, see if we can get them to not go to Costco and get them to shop us instead. Adam, you have a comment?
Yeah, basket, if you have transaction log data, you can see basket discounts versus product discounts. The guy got $2 off. Did he get $2 off because he bought this product, or did he get $2 off because he had a basket size? Yeah. It's a critical part of planning.
Mm-hmm.
Yeah, that's right. Yeah, so we want all that insight into the shopper, and I will. I think I'll just interject here because I think it's important. What we're really doing is putting prices in the store that the shoppers want, that they expect, based on, your service level, your convenience, and so on. And by doing that, what you really are after is where the shopper just picks up the item, puts it in the basket, and doesn't even look at the price. That's what you're really after. The last thing you want is for someone to pick up two products and start comparing. Oh, this is a 4 count, that's a 2 count. Should I buy 2 of the 2 count instead of the 4 count? How much of a discount is there? Oh, the 4 count is an Energy Star rating, the 2 count's not. Oh, look at this. If I went to the Energy Star rating on the 2 count, maybe that would, you don't want people sitting there in your aisles, having to do all the mental gymnastics to see which item they want to buy. They should just buy the one they want and know that this is a retailer I trust, and that price is going to be the right price. And I never have to second guess it. What that does is it means that the transaction moves towards a more frictionless transaction. And the more transactions that occur in a free society, the better, because every transaction benefits the buyer and the seller. That's, the fundamentals of a free market economy. Now we're getting into things that we believe in. Let's get back to the math. What else you got there?
I just have one more question.
Okay.
Can this type of analysis be done for new product introductions?
Oh yeah, absolutely. Most new products tend to be pretty similar to products that have been carried in the past, and there's lots of ways to infer demand from a similar product. So yes, it can absolutely be done. So look, I think we're at the end, so I will leave it. Do you have a wrap up?
Yep, just a little wrap up.
Okay.
Yeah. Thank you all for joining today. If you have any other questions or you want to learn more, please reach out to Jim or myself, or you can reach out to ClearDemand through info@cleardemand.com.